Hello, Lyons clients and friends. We have gotten some interesting angles from the big, beautiful bill. The things I'm going to go over in this video quickly are two major components that I think are worth sharing with you. We have a deadline that's coming up, which is the end of this year, going into Q1. So rather than meet with everyone individually, I'm doing this video so we can kind of get the concept to you pretty quickly, and hopefully it makes sense to you what I say. Obviously, you can follow up with questions. Everybody's plan is different. This is primarily for if you own real estate in an investment property, you have an IRA, and you have income. So I call it the 3 I's. And then the second presentation I'm going to give is basically Roth conversions, like how do you transfer money from regular IRA accounts to Roths, and how beneficial is it to do that with your investment plan. And I think if you've got an IRA account and you're younger than 75, this is a no-brainer. We have a vehicle that's closing Q1 that is perfect for this conversion. So let me get right into it. So this is subject one. You own an investment property, okay? And in the old days, so let's say the investment property is 1.5 million. Your New Smyrna beach house, your cabin in the mountains, whatever. Your house is worth 1.3 million. The land is worth 300,000. We can't really depreciate that. The old rule is 27-year deduction of depreciation against your active income, passive losses. Okay, but now there's the 100% depreciation brought back by Donald Trump. Politically, if it was Biden, it'd be his picture. But Trump brings back the 100% depreciation. So the way this works is if you do the majority of your professional career, more or less 51% of your time in real estate investing, you do a cost segregation study, which basically says how much is the wood worth that built your house, the nails, kind of a breakdown of your building, and it costs about $2 or $3 grand, so it's not a crazy amount of money. So if you do all of this, what does it mean? So we can depreciate 1.2 million because of the new big beautiful bill. What does that mean, Tom? What it means is you can accelerate depreciation. So in this case, you have 1.2 million. You can take 25% up front, so that's 4 years by 25, $300,000 day one depreciation, and you can still do your 27-year standard deduction. So you can depreciate now, this year, 2025, it's not too late, $332,000. And what does that look like? Okay, so let's say that you rent your New Smyrna rental out for $100,000 in rent. It costs $35,000 to do it. You net $65,000. You pull that 332 over. You have $267,000 of paper losses. In the old days, it would be passive losses against active income. Now it can be taken as active losses against active income, as long as you do, as I said, sit 51% of your time doing real estate. I invest in properties and I spent a lot of time on them. I think it's easy to justify. And also there's a couple different variations of this. There's short-term rentals, there's long-term rentals. So I'd have to get into a little bit of specifics for you, but what does this look like for your tax return 2025? In April, it's too late, okay? You have W-2 income, whatever, dividends, 300,000. You take that 267, you subtract that from your income. Now your income's $32,000, 10% tax bracket. Your income tax bill that year is $3,300. If you don't do this, you have $300,000 income at 35%. Your tax bill is $105,000. So this whole new situation, you save $105,000. I guess against over $100,000 of cold hard cash saved. To me, that's worth doing a couple of things like this cost segregation study, and maybe some short-term rental concepts that I'm not going to get into right now. So that's subject one. Subject two, this is the Roth conversion. Again, I didn't know about this. I probably should have before. Roth conversion. How does this work? Okay, you got $1 million IRA account rollover from your company, whatever it may be. So if it's an active IRA, like if it's a 401k, you can't do this. So it has to be something that's rolled over, or an IRA that you've had for many years, whatever it might be. Let's say this one's $1 million. Now this is the fund, I jokingly call this Saunders 2 kind. It's actually called S2K. It's a real estate investment fund specifically designed for Roths, okay? So you take $100,000 for 2026, $100,000 for 2027. You open a separate IRA, which then invests in the fund. And they do a fair market value study is what it's called. And if you think of pre-construction, they can lower the pre-construction value down. And when you convert to the Roth, Now instead of paying taxes on $200,000, you're paying taxes on $120,000. So you're saving $80,000 of income. But guess what? We're going to use the first subject to mitigate that income. And then year 2, that valuation goes back to $200,000. It's about a 5-year hold, should be worth around $340,000, 1.7% rate of return. But when you take the Roth out, it's tax-free income. We did the math. Tax-free income out of $1 million Roth. If you pay taxes on it, it lasts about 12, 13 years. If you have tax-free income, it lasts 30 years. So you get 18 more years of basically cash flow from your Roth IRA because it comes out tax-free. And that to me is a bit of an annuity killer as well. And that's really all I've got. I'm going to send this video, watch it a couple times. If you have any questions or want to get going on this, let me know because like I said, we got about 6 weeks before the end of the year. Hard to believe. But that's all I got for you.